Hello, my name is Amelia, and today we're walking through the Real Estate and Commercial Property Lab. It's an interactive tool built for anyone who wants to understand how real estate actually gets bought, financed, and valued. Anyways, let's get into this. So here are the different property types. Most of them you already know. Maybe the most notable one is the specialty type right here, which includes data centers, self-storage, senior housing, and student housing. Each of these types behave a little bit differently because a warehouse and a hotel, although they're both real estate, they do have completely different risk profiles. So you'll read right here that the risk spectrum ranges from core deals to opportunistic deals. One of the reasons why fintech should care is because for a really long time, real estate has been the least liquid, least accessible asset class for regular investors. And technology is chipping away at that through fractional ownership platforms that drop minimum investments from $50,000 down to $100. AI-powered valuation models that speed up appraisals, and secondary markets that try to make illiquid property feel like a tradable stock. All right, so moving on to the single most quoted number in real estate, the cap rate. Think of it like the money you'd calculate if you rented out a spare room. So take that income, subtract the expenses, divide the number by the price, and that's your cap rate. So with this simulator, you can move the different sliders here, the rent, vacancy and credit loss, and operating expense. So as you are moving these sliders, go ahead and notice that these numbers change. So like the net operating income and the implied cap rate. Essentially, a lower cap rate means that the market thinks the property is safer or has more growth ahead, while a higher cap rate is the market's way of compensating a buyer for extra risk. So right now in 2026, you could see that cap rates are mostly holding steady across the different sectors. Okay, moving on to financing. So lenders care a lot about whether a person's income can cover the loan payment, which is measured by the debt service coverage ratio, or DSCR. Most lenders want to see that ratio at 1.2 to 1.3 times or higher. This is similar to how a bank checks that your paycheck can cover your rent before approving an apartment lease. Now, in real estate, there's a difference in perspective when it comes to positive or negative leverage. Positive leverage is when borrowing works in your favor when the property's cap rate is higher than the cost of the debt. Leverage is negative when the cost of debt exceeds the cap rate. And then here on this graph, you'll see how sensitive DSCR is to interest rates. So once you've got net operating income and financing down, we move into how professionals actually value a deal, the 10-year DCF, or discounted cash flow model. Here you can plug in your assumptions starting at NOI, and down here, the tool will spit out net present value, unlevered IRR, and an equity multiple. The single most common mistake people make is applying today's cap rate to your exit value years down the road. Markets and buildings both age, so a more conservative exit assumption is the professional standard. All right, so moving on to rates. Not everyone wants to buy a building outright, and that's where real estate investment trusts come in, or REITs. They let you buy real estate exposure the same way you'd buy a stock. By law, a REIT has to distribute at least 90% of its taxable income as dividends and keep the bulk of its assets and income tied to real estate, which is why they've historically been popular for income-focused investors. So when you look here, these are the key metrics investors use instead of standard earnings because normal net income gets distorted by depreciation on real estate. It's a good entry point for understanding wealth management because you'll see that rates are often how real estate ends up in a retirement portfolio in the first place. So, on to tokenization. This is where things get a little spicy. If you don't know what tokenization is, go ahead and read through this. So, essentially, tokenization takes a property, puts it into a legal entity, and represents ownership as digital tokens that can be sold to investors in smaller pieces and, in theory, traded more easily than a whole building. This is a fast-growing corner of the market, and some estimates put tokenized real estate on a path from a few $100 billion today toward multiple trillions by the mid-2030s. However, tokenizing a property changes who can own it and how easily they can trade it, but it doesn't do anything to change the underlying risk of the building itself because vacancy is still vacancy and a bad location is still a bad location. That's a distinction worth sitting with before getting swept up in any sort of hype that you may hear. All right, so let's zoom out a little bit and ask a simple question. Why own real estate at all, alongside the stocks and bonds that are already in your portfolio? So this section right here points to income durability, uh, partial inflation hedge, added diversification, and tax advantages. Also, something to note is that direct real estate has a much smoother reported volatility than public rates. But that's partly an illusion caused by how infrequently direct properties even get appraised. Public rates trade every day, giving you a noisier but more honest picture of how volatile real estate actually is. So, let's focus in on the real estate cycle: recovery, expansion, hypersupply, and recession. Something to be aware of is that each part of the cycle moves at different speeds. So, right now, for example, you'll see here that office is in a slow, uneven recovery. National vacancy has actually improved because top tier buildings are filling up fast. However, older buildings are struggling. Meanwhile, industrial and multifamily are in a much steadier spot. And so you'll see here expansion, hypersupply, recession, and recovery. And finally, the last tab is an FAQ that answers questions that are asked by those who start underwriting their first deal, like why identical NOI buildings trade at different prices and so on. So go ahead and read through that. So that's the tour. Feel free to follow along in the lab because that's where a lot of the learning does happen. You can move the sliders and build your own deal, see how assumptions all interact with each other. But yeah, that's it. Thanks for watching. I'll see you in the next video.